Valens Research, Uniform Financial Analytics.
AT&T, you would assume, incredibly boring business, and it has been a very stable average ROA business, right? When you just look at it, AT&T's ROA over the last 10 years, basically, has been right around 5% almost every single year. Now, analysts are forecasting that AT&T is going to see ROA inflect higher in 2019 and 2020. Why? Because obviously in 2018, right, with their acquisition of the Time Warner content, they basically acquired a higher return business. What the market's pricing in right now is a 6%, right? So really, what's interesting is on an as reported basis, you would think this company was lower ROA than it is. But the way more important thing is if you looked at as reported metrics for AT&T, you would think AT&T is a lot cheaper than it really is, right? If you remember down here, this chart at the bottom is our forward VE prime, our adjusted PE metric versus as reported PE. And what we can see here is when we look at an adjusted PE metric, we can see that AT&T isn't trading at a 10 times multiple. It's not trading at half market average returns. It's trading at an 18 times multiple. You look at AT&T on an as reported basis and you would think, oh, this is a low return business that the market is very pessimistic on. If I'm a value investor, I look at AT&T on an as reported basis and I say, hey, this might be a turnaround, or at worst, if the company can just stay stable, the market needs to see the stock appreciate because the market's irrationally too pessimistic on the company. But when we look at it from a uniform accounting perspective, we can realize the company has seen an ROA inflection higher and the market knows that and is still pricing it to be. You would buy AT&T saying, oh, I've got a 5% dividend yield and I've also got a very healthy, and a very healthy low PE. This is a potentially compelling company to buy. But when we look at it, and what I'm going to pull up right now is what we call our credit cash flow prime, which is where we look at what the credit and dividend sustainability of this business is. And when I look at AT&T, what we see is, no, this isn't a company that has a 5% yield and has room to raise that yield because PEs are cheap. This is a company that when we look at obligations, we see that this company is basically paying out all of its obligations right now. It is not a cheap company and it doesn't have room to raise its dividend either. What this chart is that you're looking at here is our credit cash flow prime. These stacked bars for the next 5 years are the obligations the company has, from debt maturities to interest expense to rental expense to dividends to R&D investment to pensions, all the way to maintenance capex. What we're basically saying is, hey, for the company to keep the lights on, this is what the company needs to spend on before we even look at the cash flows. This blue line is what the cash flows before all those obligations are forecasted to be for each of the next 5 years once we make all of our uniform accounting adjustments. This blue dot here is what the cash on hand plus cash flows are. And so you can see basically cash flows match obligations every single year for AT&T. AT&T isn't trading cheap with opportunity for dividend expansion. It's fully valued and it doesn't have much room for dividend expansion. You literally see directionally different ideas on AT&T if you're looking at it. And AT&T isn't the only company that has these kind of PE issues. When we do an analysis and we basically just say, let's take the bottom quintile of PEs on an as reported basis and a uniform accounting basis, meaning let's look at the companies that are the cheapest on a PE basis. When we compare with the companies that end up in both the bottom fifth, the cheapest fifth of companies on an as reported basis and a uniform accounting basis, we get an overlap of only something like 50%. Meaning when you do a screen, assuming you screen for idea generation and you screen on PEs and you say, hey, I want a company with a cheap PE, half of the companies that you're screening on, half of the companies that you think are cheap and are a compelling investment opportunity aren't actually cheap. They're companies like AT&T that are trading at market average valuations. And if you weighted in those names, you're probably looking at dead money at best. And at worst, if actually fundamentals roll over in the business, you could be looking at downside.
Valens Research, the world's leading source for uniform financial analytics.